Okay, so we're gonna have a quick look at this question. We're gonna look at payback, average rate of return, and then we'll look at net present value as well. So the first thing we need to do is get our cash flow table at the top sorted. Okay, so this bit here, and all the information we need is up here. So they've given us all, at the top of the page. So I'm just gonna highlight some key bits. Okay, so we've got to complete the cash out section. Okay, so I'm looking for anything to do with the money that's going out of the business, and it tells me up here that the initial cost of buying this equipment is going to be £1 million. So straight away, I know there's going to be £1 million going out. So I'm going to show that immediately as leaving the business. So I've got £1 million here. Okay, 1 million going out, and in year 0, when we buy this piece of equipment, there'll be nothing coming in. That's just showing the money going out, and I'm going to put it in brackets to show that it's negative. It could be a negative you could put in front of it, or it could be in brackets. Therefore, our negative cash flow, we're £1 million down, effectively, in year 0. What we need then is the money coming into the business. So we're looking for inflows. So I'm just going to colour code it to make it easier. We've got cash coming in is what we're looking for. What we know here is that the sales in year 1 will be 300,000, and they're going to grow by 10% for the next 5 years. Okay, so pretty straightforward so far. I know that in year 1, I've got cash coming in of £300,000. Okay, so I'm going to put £300,000 in. Okay, and it's telling me that it's going to grow by 10% every year. Okay, so 300,000 is coming at this point here in year 1. It says year 1, 300 grand is going to come in. So I'm going to put 300,000 into my calculator, and I need to add 10% on top of that. So I'm going to times it by itself and a further 10%. So by 1.1. And that means in year 2, we're going to have 330,000 coming in. All right, and that's going to happen every year. It's going to increase by 10%. So I've got my 330,000. Going to times it by 1.1 again. It's going to take us to 363,000. Another 10% on top of that for year 4. It's going to take us to 399,300. And finally, another 10%, year 5. So in year 5, 439,230 £230 is going to come in. So we've got all our inflows there, but what we need are the other outflows, and it's saying that annual costs, all right, will be 30% of the sales. So we're going to do them one at a time. We'll take it from the top again. So in year 1, we had 300,000 coming in, and I need to know what 30% of that would be. Okay, so I'm going to times it by 0.3, and that means that the costs are going to be 90,000 in year 1. And I'm just going to repeat that all the way through. So we know the inflows in year 2 were 330,000. If I want 30% of that, it's going to come up to 99,000. Year 3, we've got 363,000, so I'm going to times it by 0.3 to get 30%, and we've got £108,900 leaving the business. Year 4, 399,300. Again, 30% of that, 119,790. And final year, we had £439,230 coming in. Times that by 0.3, and it's 131,769. Right, so we're nearly at the point now where we can do what we need to do. I want you to bear in mind that sometimes in the exam or in assessments, this will all be done for you already, okay? They might just give you this column here, just the net cash flow column. This is the key column, all right? We need to complete this bit so that we can do payback, ARR, and NPV. So sometimes to trip you up a little bit, they'll make you manually work out the inflows and the outflows. So remember, to get net cash flow, we need to take away the outflows from the inflows. So, you know, I know by looking for the first one, if 300,000 is going to come in and 90,000 is going to go out, got 210,000. Okay, more is coming in than going out. So obviously use your calculator in exam conditions anyway to just make sure you sort of nail it on, just double check them. I'll do the rest. So I've got 330,000 coming in, I've got 99,000 going out in year 2. So it's going to put me on 231,000 and so on. So 363,000 coming in year 3, got 108,900 pounds going out. It's going to put us on 254,100 pounds. I'm just going to keep going, repeating that method. So 399,300 comes in, 119,790 is going to go out. So we've got 279,510. And last one, then we're in a position where we can start doing the calculations. It's 439,230 comes in, 131,769 goes out. So the cash flow for year 5 would be 307,461. All right, so now we've got this bit, this column, the net cash flow, we're in a position that we can look at doing payback, average rate of return, and calculate the net present value. Okay, so we're going to look at the payback period first of all. So remember, payback's going to show how sort of quickly you get your money back. And in an exam, it might say they want a payback period of like, I don't know, say 3 years and 10 months. And you've got to work out and show, you know, what that point will be in terms of months and years. So the way to do it is to keep a running total in your calculator. So I know that they're going to be, there's like £1 million is basically going out of the business. Okay, so millions going out. And what we're trying to do is get rid of that money. Okay, so at what point does that, you know, maybe look at it as break even, for example. At what point is it enough come in to balance out the million that's gone out? So I'm going to knock off £210,000 because in year 1, 210,000 is going to come in. Okay, so year 1 done. That's going to leave me with £790,000 to get rid of. Well, 231,000 is going to come in year 2. So I'm going to knock off 231,000. All right, I'm going to put a dot there so I've done that one. I've still got 559,000 before this machine pays for itself, or this piece of equipment, whatever it is. So in year 3, there is 254,100 coming into the business. So we're getting closer, but not quite there yet. 304,900 still needs to be recouped. So I'm going to get rid of the available income in year 4, which is 279,510. Okay, so I now know that all I've got to do is get £25,390 back out of this money here, and at that point, this piece of equipment has paid for itself. So I know it's going to be 4 years and something. I can see that, you know, taking off years 1, 2, 3, and 4. But what I need to know is what is the something going to be. So the way to do it is to divide it by, I'll show you. Okay, 25,390. So I need to get, you know, get back. The available cash flow for year 5 is 307,461. And then I'm going to times it by 12. Okay, we want to times it by 12 because that will give us the answer in months. That's what the examiner is looking for. So 25,390 divided by 307,461 times by 12. Okay, comes out as 0.99 months. So we're going to round that up to 1 month basically. So I know the payback period for full marks is going to be 4 years and let's say 1 month to cover it. So a running total in your calculator, you know, we'll do it every time. Put the outflow in your calculator, the amount of money you're trying to recuperate, and just knock it off one by one as you're going through. get to that point where you've got a figure that you need to get rid of and you've got enough available cash flow to do it, divide what you need to get rid of into the total available, times it by 12, and that'll give you your answer in months. If we wanted to do it in days, we would times it by 365, but generally we're looking for years and months. Okay, so payback period for that piece of equipment is 4 years and 1 month. Right, if we have a look at average rate of return, so remember payback is the the period of time it takes to get the money back. Average rate of return is going to show us the return available on this expense basically. So there are a number of steps to do it. Step 1 is to add up all of your cash flows. So I'm going to add these 5 together. We're then going to deduct the outflow, the million, and the clue is kind of in the title, average rate of return. We need an average. So because they've given us 5 years worth of data, we're going to divide it by 5. If they'd given us 3 years worth, we divide it by 3. But in this case, it's 5. And then we're going to divide that average back into the £1 million and times it by 100 to look at what return we're going to get on that money, basically. So as I said, first step is to add all of your cash flows together. So I've got 210,000. 231,000, 254,100, 279,510, and 307,461. Okay, so it's going to come out as 1,282,071. Okay, so my total is 1,282,071. You can see that there. So I've added them all together. Step 2 is to deduct the million. So let's get rid of the 1 million, which is the expense. We always need to get rid of that cost. And it's going to leave us with £282,071. Okay, over its lifespan. Remember, we need that as an average. So I'm going to divide that by 5. And it's going to come out as £56,414.20. So that's the average per year. So every year it's going to generate on average £56,414.20. And we now need to work that out as a percentage of the outflow. So basically I'm going to divide that by the million. Okay, and then times it by 100. And it comes out as 5.64%. Okay, if you wanted to simplify that, you could think of it as for every £1 they spend on this piece of equipment, it's going to generate 5.64 pence after all costs have been covered. Okay, so last one we're going to look at is the concept of net present value. This always seems to be one that people seem to find a bit tricky, but it's quite simple really once you look at the method behind it. So with net present value, one of the benefits of it is that it allows for the changing value of money. How money changes over time, what you can and can't buy for your money. If you think about the prices of certain products when you're younger, like the Freddo effect, think how much a Freddo costs when you're younger compared to now. The price of bus tickets, things like that. So one reason this model is used is because it allows for these things here called discount factors. So the discount factors will always be given to you, okay? You never have to work them out, that's the good news. And you can see the discount factors up here, so I'll highlight them. It's got discount factors for years 1, 2, 3, 4, and 5, okay? Somebody, somewhere in this organisation, has basically said that they think that these discount factors are going to come into play. So you don't have to dispute that. All you've got to do is work out how that's going to affect your investment. So in year 0, if you look at the discount factor here, the discount factor is 1. So nothing's going to change at all. They're basically saying that £1 million today will be worth £1 million, which it will because it's present value of the money. So in year 0, all I've done is I've taken my cash flows from here, they're exactly the same. I've written them down here. I've got a bit more space to work it out. You'd be free to work them out manually down the side if you wanted to in an exam or a test. I've just moved them down here just for the ease of doing this video. So in year 0, £1 million is worth £1 million. So that investment still stands. It's in brackets because it's a negative, it's money going out of the business. But what starts to change a bit is when we move on. So year 1, we've got a net cash flow of 210,000, okay? And someone's applied a discount figure of 0.91. So all I'm going to do is put 210,000 into the calculator. I'm going to times it by 0.91. And that's coming out as 191,100. So £191,100. So somebody's saying that £210,000 in a year's time will actually only be worth £191,100. And that's the thinking behind it. And we just repeat that method as we go through. So for the next one, I've got £231,000. I know that in year 2, the figure I've been given is to be discounted to 0.83. So I'm going to times those two together. And I'm getting 191,730. And just repeat that method. So what are we on? Year 3, £254,100. The discount table's telling us that'll be worth, only 75% of itself because the value of money will fall. So discounting it is going to come out as 190,575. And last couple, year 4, we've got a net cash flow of 279,510. Got a discount factor here of 0.68, so I'm going to times it by 0.68. Okay, it's basically saying it'll only be worth 68% of itself. Comes out as £190,066.80. So we start to move into some decimals. And the final one, before we can work it out, is a net cash return of 307,461, and times that by 0.62. And it's going to come out as £190,625.82. Alright, so all the hard work's done now. This probably involves the most effort in terms of workings out, and it's quite sensitive. If you get one of these wrong, it will skew your answer quite badly. But all we've got to do now is just add them up, okay? And it's similar to average rate of return, but we're not looking for an average here. So these years 1, 2, 3, 4, and 5, I'm going to add those together now and see what I get. So I've got 191,100 in year 1, 191,730 in year 2, 190,575 in year 3, 190,066.80 in year 4, and last year £190,625.82. Okay, so that's going to total £954,097.62. But we need to get rid of the £1 million, okay? Always got to deduct the cost. So get rid of that £1 million to see what we're left with. So I can tell by looking now, this is going to be a poor investment because it's going to come out as a negative. So if we drop that £1 million, okay, and then the NPV, the net present value of this investment, is going to be negative. So it's going to be negative £45,902.38. So remember, you could put it in brackets or you can put a negative regardless, but that's showing that that's not a sensible investment. If these discount factors are correct, I mean, that's one criticism of this model, is that these are somebody's predictions and the external environment can change so quickly. But allowing for these changes, these predictions, this wouldn't be a wise investment, okay, because you would lose money on it. If it came out as a positive net present value, then it's said to be, safe to invest. So for this overall answer here, if they're going to buy this restaurant and equipment, it's going to they get a payback of 4 years, 1 month. They're going to get a return of 5.64%, but they're going to get a negative NPV. So overall, that might suggest it's not going to be successful. You've always got to bear in mind what the examiner's asking or what the case study says. You know, so let's say they said they wanted a payback period of 4 years, 8 months. They wanted an average rate of return of 7%, and they wanted a positive NPV. Well, you'd be paying back, you know, earlier than they wanted, which would be good, but you wouldn't be getting the return and you wouldn't be getting the NPV. It very much depends on what they say, and that's what you need to build into your answer. So all useful models, all ones you need to know, and remember, the quicker you can do them under exam conditions, you know, you'll get to the point where you can do these in a minute, 2 minutes. You're clawing back time for the longer questions at the end, which you can really rinse top level value out of to get those high marks. If you need to look at this in your books, this is on page 150. It's at the back of your books at the moment. If you want to have a go at it, work it through, and then maybe just check your answers against what I've done. But any questions, let me know. Thank you.